So, good morning, everyone. Welcome once again to our weekly webinar, Lessons from the Lockdown. And absolutely delighted today to be joined actually by two guests that we'll be talking to as we go through the webinar. These are, of course, 30-minute webinars, sort of brief to the point, designed to be informative, inspirational, and really just focus your mind for these 30 minutes on what's happening in the world of property, give you some tips to take away and implement in your own business or investment experience. So my name is David Johnson. I'm the CEO of LEOcrowdfunding. We are a property crowdfunding platform. And my co-host, as most weeks, is Mr. John Corey. I'd like to introduce yourself, John.
Hey, good morning, everyone. It's pretty pleasant today in London and interested in hearing today's topics.
Yes, well, indeed. And we'll introduce our guest just in a moment, but you can see Ayesha there on the screen. And today's topic is vanilla deals. What do we mean by that? And why do investors particularly like them? But let's just do some of the other intro bits first. So if we go to the next one, please, Asher. Okay, so part of what we've been looking at for the last number of weeks is getting people to think about what is your strategy. And this applies to fundraisers, landlords, as well as to investors. And one of the basic questions sometimes gets asked is, do you actually have a strategy? And has that strategy changed in any way because of, I suppose, the economy, COVID, and just things that have happened in the recent 7-8 months? And as part of that, we did a nice review. If you move on to the next slide, Asher, please. We did a nice review around the regions and got into some really good information and details on that. That's okay, so pop back up again. That's okay. No, I was about to do you, Asher, if you just go on to the next slide as it was.
Massive apologies.
Yeah, you are. So what I wanted to do was, as you've gathered already, a lot of a different look and feel of our presentation. So rather than John and I's presentation over this last 6 months or so, we've done a little bit of minor tweaking in there. But as I mentioned last week, we've actually brought on a new member of staff. He's the head of online marketing and social media, Mr. Asher Weiner. And Asher has...
Good morning.
Good morning, Asher. How are you?
I'm very good, thanks. How are you doing?
Excellent. Very well indeed. Very well. So I'm not going to steal your thunder. I'm delighted to have you on board and take a minute or two just to explain your background, both in social media marketing and also in property. And that would be great for our attendees.
Oh, cool. I mean, my background, I guess my property journey started, I must have been about 16 years old when, I was during my A-levels, I used to get involved with quite a few estate agents because that was something that I got involved with because that was something that I, always felt like it's a great place to earn money. It's a really interesting industry. And that ended up me going to Nottingham Trent University to study property planning and development. And after that, I got very much into my music and my nightlife. However, marketing has always been, a strong interest of mine. So, I've done a full circle by coming from music and nightlife back into property and using my marketing expertise that I've learned along the way to use it with LEOcrowdfunding and hopefully along the way be able to educate everyone watching as well on how to market your projects and the best way to carry yourself on social media. So hopefully we'll be able to get to that within the next few weeks.
Yeah, absolutely brilliant. We have lots of ideas and lots of things we're talking about that will be implemented on our social media channels and as we deal with fundraisers. So really excited to have you on board, Asher. And you did spend some time at Lang O'Rourke. So you've sort of worked in a property environment. So that obviously gives you a really good sort of understanding of what it means to be in this industry. Of
course.
Okay. So I say you'll be seeing and hearing a lot more from Ayesha, and as you probably already gathered, one thing I've done is handed over the slide presentation to Ayesha rather than doing it myself. The delegation is a great skill in business, so we'll be allowing him to change these slides as we go along. So if we go on to the next one now, please, Ayesha. Okay, so just to wrap up where I was earlier, we did a nice review around the regions. Very interesting. John, any quick observations, or what did you find? Did you learn anything you hadn't expected to learn as we did the different regions?
So it was more about the people who were speaking about some of the regions, getting to know some of them that hadn't met before, things like that. I'm less into regional trends and more into individual deals. So I think you make your money from the deals you negotiate, not what's going on in a region, but understanding who the players are and who knows what's going on, what the growth plans are when it comes to businesses or infrastructure, things like that do matter. By the way, just so folks know, if you have questions, put it in the Q&A. We'll be watching the Q&A for questions.
Yeah. Okay, next slide, please, Ayesha. Yeah, and just go on over the next one as well. I'm sure John doesn't want to talk about his crystal ball again for another week, so we'll move on past that slide. So let's get straight into our special guest today. Absolutely delighted to be joined by Ayesha Ofori. You can see from the tagline there, Ayesha runs a number of businesses, very high profile, and is also our strategic director at LEOcrowdfunding. Provides valuable insight and obviously has been very much involved in the development of the business. So absolutely delighted, Ayesha, you're able to join us today. How are you?
I'm very well, thanks.
Good. And how's life in your part of London?
Busy, always busy, but busy is good, particularly in this environment. Yeah,
no, very much so. So do you want to just take a minute, and I'm sure with a number of attendees who maybe aren't aware of your full background, so why not just share your business
Sure. Sure. So for those of you who don't know who I am, as David mentioned, I'm Ayesha Ofori. I guess my background originally, many moons ago, started off as a scientist. I was a physicist, then went into banking for best part of 10 years. Started off investment banking division, working at Morgan Stanley in their real estate investing team, and ended my banking career at Goldman Sachs, where I was for 6 years as an ultra high net wealth advisor, where I would essentially manage money for Goldman clients. And I managed that money across various different asset classes. Equities, bonds, private equity, currencies, commodities, pretty much most asset class, ironically, very little property. I actually started investing in property myself a number of years ago with my husband and very quickly built up a sizable portfolio. Realized I had a passion for it, but also realized that there are lots of people out there who weren't getting exposure. So I decided to do something about it. Long story short, set up multiple businesses, all focused around property. So it's not as if I'm a sort of doctor, solicitor, and an accountant. Property is my passion, keeps me very busy. And one of those roles is working with David and the team at LEOcrowdfunding to, democratize property investing.
Excellent, absolutely fantastic. So we're looking forward to today, to getting into our topic. So if we go on to the next slide, please. So in an environment where there is so much change, not just because of COVID, there's always economic change and different factors and different things that impact the property market, which of course then impacts investors. But you've obviously got a lot of experience dealing with investors, particularly high net worth and even uber high net worth investors. So what we thought would be really interesting is to really just work through this concept of what we call a vanilla deal. And I'll let you sort of explain what that is. And then I'm going to let sort of John and you sort of bounce back and forward and just work through the points on the screen. And I think it'll be really valuable for fundraisers to understand what investors are looking for. And even for investors to perhaps see some of the things that they should be judging deals by. I think that's the two big takeaways. I see from the session today. So if you explain what sort of vanilla deals are, and then John, you and Ayesha can kind of bounce back and forward, and I'll come in at the end.
Okay.
So I guess, well, I like my deals vanilla, but I actually like my ice cream with more flavor. And the reason that I like vanilla deals, or first of all, what is a vanilla deal? Essentially, some people say vanilla is the boring flavor. And by boring, it usually means not complicated, quote unquote, straightforward. In property, very few things are straightforward, but you can get certain types of deals and deal structures which have less complications. And generally speaking, I find when there are less complications and things are more standard, it's easier for people to understand on all sides. It's easier for investors to understand. It's easier for investors to follow. And to track what's going on. And particularly when you work in the retail space, I think that's even more important. When you start to work with more sophisticated investors who understand, I guess, the nuances of deals, then you can, it's okay to get more complex, to have more bespoke structuring. But when you're working, I think, in an environment where you're looking to have multiple investors in your deal, I think keeping it as simple as possible works on all sides. And that's essentially what vanilla means. Now, everyone will have different definitions of what vanilla means for them. So as John and I go through this is very much, our opinions. It's not sort of set in stone. And equally, there's some flexibility around this. So we'll go through and we'll talk about different metrics and different numbers associated with the topics that you see on the screen, but they're just a guideline. It's not a sort of hard rule that if a deal doesn't fit into any one of those metrics, then the answer is no. In this industry, it's always about negotiation on both sides and finding that sweet spot that works for everybody. So I guess the first one says residential development projects. So in property, there are lots of different types of strategy, which mean there are lots of different types of projects you can invest in. You can invest in residential projects or development projects, which could mean building from the ground up. It could be a conversion of an existing property. You could do a deal that is a planning gain deal or a planning uplift deal. It could be on a project that's an HMO or a project that's on a buy-to-let. When I say that I'm looking for something vanilla, I tend to mean development projects. So a project whereby you'll either be building something from the ground up, whether it's a number of houses or a block of flats. You'll look for investor funding. The developer will have an idea of how long they think it's going to take. And the plan typically is to build these units and then to sell them. And the reason I like those types of projects, or why I call those vanilla, is because the trajectory of the project is quite nicely defined. It's not like a buy-to-let, for example, or an HMO where you're continually getting tenants in and the project is, I guess it will always have an end, but it's potentially never ending because you'll continue to, or the developer will continue to hold the project and rent it. With a development project, there's a nice sort of finite end, if you like, and that's what I particularly like. I mean, John, what are your views?
So I think it's important for everybody here that you're very focused on, I think, what you could argue is the widest part of the market. So residential housing for owner-occupiers, maybe for investors to buy, but essentially build it and sell it, residential. It's the wide part of the market. Jumping all the way down to your last point sort of ties into the first point that, there's maybe subcategories within housing, but it is still, again, the biggest part of the market and possibly the easiest to see when you're finished to sell it on and to move it on, that there's an absorption, that people are willing to buy properties, and we know there's a shortage of housing. As you said, it's not to say that other types of deals don't work on the platform, but what you're going to label a vanilla deal for the platform would fit these criteria with some wiggle room possibly in some individual items. So it makes sense that if you're trying to keep it simple and keep it sort of the widest piece of the market, this would be it.
Exactly. And I think just touching on one of the points that you said, it's not to say that I think any other types of deals don't work or I don't like them. On the contrary, I think from an investor perspective, it always makes sense to diversify your portfolio and to have diversify across the different types of investments that you're investing in.
Those are the other flavors of the ice cream.
Exactly, and as I said, when it comes to my ice cream, I do like to mix it up a bit. But particularly if you're starting, I think vanilla is a good place to begin.
Cool.
So just touching on the second point there, the return on investment. So from an investor perspective, this is what you would expect to make on the money that you've invested into this project over the life of the investment. And I think the key word there is expect.
So this is the person putting the cash in, not the person running the project, right?
Yes, exactly. So I'm talking about it now from an investor perspective. So as an investor putting your money into a project, what sorts of returns can you expect? Well, in a nutshell, I mean, you can have all different kinds of expectations in terms of what you'd like, but fundamentally, the return is going to be driven by the project and by the developer, and also by the type of investment that you're making. And here we're only talking about equity type investments, where you would put your money into a project and you would end up getting a share or partial ownership of the entity that controls the asset. Now, in terms of equity deals and the types of returns that I've seen investors making, it really does vary depending on what's happening in the market, also on the project and the area. But I'd say overall, you can look at sort of certain ranges. And for equity investments, I'd say that I've seen projects that start at sort of 18%. Per annum and go up. Typically, the projects that I've been looking at recently are returning in the region of 20% per annum. And I think to a lot of investors that sounds absolutely fantastic, 20% per annum. But very, very important thing to note: A, it's expected, and B, the reason that a return would be so high is because you're taking on a relatively high level of risk. Whenever you see returns that are high, essentially you're getting paid to take on risk. So on the one hand, yes, you may feel 20%, that's fantastic. You always need to bear in mind what the implications are and what that means. So when it comes to return on investment, absolutely you are looking at the fundamental number and how much money you can make, but you also need to look at how much risk you're taking on to decide whether or not it fits within your risk tolerance. As I said, I think for me, a lot of the deals I'm seeing at the moment are coming in at around the sort of 20% per annum return for investors. I imagine there are some developers on this webinar who are probably sort of shaking their head and thinking that's a bit high. But as I said, it's not a number that's set in stone.
I want to make a point about this. Ayesha's been saying, so it's clear to everybody, 20% per annum. I'm not saying, and she's not saying that you always have to pay that or that's the only number, but I want it really clear that it's per year or per annum. There was a deal recently that closed. It's an older deal. It was funded. It's been running. It ran over. And it turned out that one document said there was a rate of return for the life of the project, and it was less than 20%. And another document said it's that rate of return per year. So now there's a dispute about, well, I didn't get multiple years worth of return. I only got total return. And so you need to be very good about understanding if Ayesha's saying 20% per year, you need to make sure all the documents say 20% per year or 18 or 17 or 21. Wherever it is, make sure everything lines up and that everybody's on the same page.
Yeah, and that wasn't our platform, just to be clear, just in case people think that we're talking about something on ours.
It's not even important if it was a platform. The point is there were people misunderstanding what they were signing up for, and partially because they didn't read. So go ahead, Ayesha.
Yep. Okay, so moving on to the third item, so profit on cost or profit on GDV. I'm not a big fan of using acronyms. But I guess it can't be helped here. But what does this mean? So this is more metrics that the developer, so the person who is undertaking the project, will be considering and should be considering and should be looking at. So essentially, your profit on cost is, I guess, a measurement of how much your total cost of your project is versus the total profit that you're making. And equally, profit on GDV is the relationship between how much profit you're making and what your total GDV is. And the reason why these metrics are important is because these numbers need to be healthy enough to leave room in the deal for when certain things change. And I'll give you an example. So typically when I'm looking for a vanilla project, I will look for a project that has at least a 20% profit on cost. And the reason that I do this is because no developer, however experienced they are, regardless of who they have on their team, will be able to calculate to the exact pound how much a project is going to cost. And on top of that, there are going to be fluctuations in the market, unexpected things that happen, as with COVID, particularly at the beginning of the first lockdown. A lot of materials weren't able to get to site, prices went up, so costs started to go up. So as a developer, you need to make sure that you've got healthy margins so that there's wiggle room when things changed. And equally, from an investor perspective, as you get more comfortable and familiar with these deals, you'll start to look at these metrics as well, so that you can get comfort that the developer is looking at these things in the right way and leaving enough of a margin and enough wiggle room in there, such that when things do start to go wrong, and there will always be something that doesn't go to plan. I've never come across a project that's gone, from beginning to end has gone smoothly. So there needs to be wiggle room, because as a developer, if you have told investors that they can get an expected return, whilst it's not guaranteed, I think it's your obligation to do whatever you can to try and, meet what you said you'll do. And to make that easier for yourself, you have to allow yourself room to maneuver. So by focusing on some of these margins, not just profit on cost, profit on GDV, something else I also look at is contingencies. So how much buffer have you left in the overall project? Some people have used contingencies of sort of 5% of cost. I ideally like to see things a little bit higher. However, I'm open to looking at projects with 5% if the developer is very experienced, very credible team. If the developer is less experienced, then I like to see higher contingencies. As I said, not set in stone. These numbers will move around depending on the project and the developer, but they are absolutely metrics that need to be considered, especially on the developer side, but also on the investor side as well.
That's really, really useful. So we've got about sort of 5 minutes on this section. So if you want to just cover those, certainly
Sure.
4 and 5, I think we need to be looked at.
Yeah. So 4 and 5. Clearly, if a deal has planning approved already, then the planning risk is off the table. If a deal doesn't have planning and the developer needs to go in, there's no guarantee they're going to get planning. So there's an element of additional risk in that project. And as I said, whenever an investor takes on risk, you should get paid for it. So typically, if a deal has full planning, the returns that an investor will get will be less than if they are taking on or investing in a project that doesn't have planning. Because if it doesn't have planning, then you have to take on that risk that it may or may not get it. In terms of point 5, indicative lending terms, what this means is a developer will have to seek debt funding from somewhere. Typically, they go to a debt lender. A debt lender will look at the project, look at the developer, make sure the developer meets certain criteria, and then agree or not to give them the debt funding. When a lender agrees to give a developer the funding, they will issue indicative lending terms. So this is a statement that says, if we were to go ahead with these deals, here are the terms and conditions under which we feel we'd be able to give you the money. 9 times out of 10, those indicative, you can rely on those indicative lending terms. But what I would say to investors is that they are indicative. So they are subject to change. But typically, a developer won't be able to get final lending terms until they have secured the funding. So as an investor, you'll be relying more on the indicative terms until the developer actually gets the money to proceed forward. And on the last point, affordable housing, this is, I guess, just a personal preference of mine, particularly. Ever since I've went full-time into the property industry, I focused on affordable housing. Because there is a massive need in this country, there is demand for affordable housing. So the way that I look at it is, if we're focusing on projects that are building affordable housing and there is demand, then you have more, or you could have more comfort that they're going to be sold, versus, for example, super prime or prime London properties where the market is very small and there aren't many buyers. Now, I go according. Sure.
Could you clarify that? Because in the rental sector, that has a very legally defined term. What do you mean?
Yeah.
Because I know it's not the rentals term.
So what I mean by affordable housing is the help to buy definition. So any property that is £600,000 or less, where somebody can get help to buy to purchase property, that's what I classify as affordable. Because
so does the developer need to be willing to be part of that program, or just have a property that's in that price range?
For me, it would need to be the majority of the units would need to be in that price range, because in order for the investors to get paid back, typically the units need to be sold. I feel that if the units can be sold with the under the help to buy umbrella, it means there's more demand and it's easier for certain types of people to buy because the government support them.
Got it.
Yep. Just conscious of timing, I think I'll wrap it up there. But if anybody has any questions, very happy to answer them.
Yep, absolutely. Fantastic, Ayesha. Thank you. I think that was really, really useful just to run through those points and very well explained for us. So thank you for that. And as you can gather, as a platform, Leo Crowdfunding is keen to engage with fundraisers who can supply these sort of types of vanilla deals. It's what we definitely want to focus on over the next 3 or 4 months. We still, of course, will do our planning uplift on our other different sectors. But this is certainly something, as Ayesha said, there's demand out there. It's a very clear criteria. And for any fundraisers who feel you meet that, then please get in touch, reach out to us. You'll see more about this on our social media over the next couple of weeks, but you have our contact details. And if you have any questions specifically for Ayesha, obviously you can reach out to her directly on her LinkedIn profile, or indeed just get in touch through the platform on that. Questions that are, there was one quick question just arrived in there. When you refer to affordable housing, Ayesha, you're not including the market for supported living, or are you?
No, not typically. So when I mean affordable, as I said, I just mean those that are eligible for help to buy. So it means that people who otherwise wouldn't be able to purchase a property can use government funding to get on the property ladder. And that doesn't mean that I won't look at, or we won't consider things with supported living, but that's what I meant by when I use the term affordable housing. Right. But fundamentally, it's just about having a deal that works and having an exit that makes sense, that where there's enough demand. So if somebody brings forward a project where the end goal is, to provide supported living accommodation, so long as the numbers stack and the demand is there, then, it's worth looking at. Yeah, absolutely. Okay, fantastic. Thank you very much for your time today. I look forward to interacting with some of the users on this. Next slide, please, Asher. Just got about 2 slides to finish off today. So first of all, I want to draw your attention to a case study that is on our platform. This is for Atalon Homes. You can see there a picture of Tatiana, who runs a business with her husband on a nice bespoke team. Really strong track record in this type of project. So if you go on to the case study, have a look at this project that Tatiana and the team have done. I think you'll find it interesting. And one of the reasons is, if you go on the next slide, please, Asher. Yep, so next week, Tatiana is actually going to be our guest. So go ahead on that next one. Brilliant, thank you. So Tatiana is going to be our guest next week. And we're going to be discussing certainly something that is really becoming a reality for many people in property. And that is, because of COVID, because of people cooped up in maybe apartments or small houses, there is a very tangible trend of people looking to move perhaps to a bigger property that perhaps has more bedrooms so they can have a home office, and also perhaps where there's a garden.
And this actually aligns very, very well with the strategy that Tatiana has been involved in recent years. And I think, John, this would be a very interesting conversation because it's obviously a reality right now. People are looking for these types of properties.
Yeah, I mean, it's a couple of points. First of all, Tatiana is the CEO of this firm, and she's definitely driving it. And it's more design-led than you would think from some of the bespoke cookie-cutter builders. These are very impressive homes when it comes to the visual impact, and they're designed for young families, families with sort of older children that might be teenage years where space is important. Also, commutability. There is still a need to go into the quote office or go in to visit clients, so you want good access to transport. But the
Okay, fantastic. You'll also be able to go on our homepage this morning, and you'll see that Tatiana has a deal that is about to launch on our platform. A deal that fits very much in with what we're talking about, and it's currently coming soon on the platform. So you can go to the case study and you can have a look at the case study. There's a recorded interest option there for any investors who are on the webinar this morning. If this is the type of deal that you might be interested in looking at investing in, then you leave your details there and an amount that you may well be willing to put in, and that literally records your interest for this upcoming project. So really looking forward next week to having Tatiana on and discussing her experiences and of course her upcoming project. So just go straight to the last slide, please, Ayesha. So John and I mentioned the consultancy most weeks, so most attendees know you can get in touch with John and myself directly. We can talk to you about some personal consultancy services if that is something that you feel you need. You can reach out to John via LinkedIn, and there's the contact details for myself and for LEOcrowdfunding. So that really wraps up today. John, any last minute comments?
I think I'm good. Fixed my headset problem. I do want people to think about the fact that there's vanilla deals, and Ayesha has access to some ultra high net worth individuals who like deals like that. That does not mean that there aren't investors for planning or other things. So you need to bring us whatever you have, and the platform will figure out whether it makes sense for the different investor groups. A number of my clients, which are not necessarily the same clients, they're working on planning and things like that. So you will see a mix of deals in the future.
Yeah, very much so. So, okay, a big thank you to Ayesha for throwing in at the deep end today with producing the slides and then hosting the slides. So I think for a first time of us doing a presentation together, flicking back and forth across the slides, really well done, and thanks for designing these. And no problem. So Rick, that's us for today. Thanks everyone for joining. Again, always keen to get feedback, so reach out to us, engage with us, and get on our platform. And we look forward to having you back next week at 10 a.m. for our weekly webinar, The Lessons in the Lockdown. Enjoy the rest of the week, and above all, stay safe.
Thank you.